Hello, everybody. Today I'm going to be going over chapters 12 and 13, and those are the bond market and the stock market. Before I get started with that, and I'll also send out an email, but I plan to have a quiz on chapters 12 and 13 because there are some quantitative problems I would like you all to practice before the exam. So we will have one more quiz coming up shortly. And then I will go over chapter 14, which is the mortgage market, but there won't be any quiz over that, but that will be included on the final. So the final will be cumulative. So it'll be chapters 1 to 14, and it will be very similar to the midterm. And like the midterm, I will make it available all of finals week and probably even that weekend, because of course I know you all have other finals. So again, you can kind of take it whenever you want to. Of course, it will be timed though once you start it. So I know that a lot of people have part-time or full-time jobs, so I hope that's enough flexibility for you all to take it when you want to. So moving on to chapter 12, the bond market. I think it was chapter 3 or 4. We already talked a little bit about bonds and coupon payments and coupon rates and everything like that. But just to refresh your memory a little bit, so the bond market is obviously composed of borrowers and lenders. You can think about it that way, where the bond issuer is the borrower and the buyer of that bond is the lender, and they're also the investors because they're looking to make a return. But you can think of them as lenders and as the bond issuers as borrowers. So the buyers or the lenders obviously demand a return, and this is what we call coupon payments for bearing the risk of default. So the risk associated with bonds, there's no fluctuation in the coupon payment, but there is a chance that a corporation or a government or a municipality could default on those and not be able to pay the coupon payments or pay the face value at the end. So that is the risk associated with them. So of course, the lenders or the investors are going to want to be compensated for that, and that's in the form of coupon payments. And further, so there's a par value associated with this. This is the same exact thing as saying the face value. This is usually $1,000. So the coupon rate is, of course, the coupon payment, the yearly coupon payment divided by the par value or the face value, which again is usually $1,000. And again, this is all just to refresh your memory on bonds and how they work. So of course, the more default risk that the company or the government carries, the higher the coupon rate, because more risk, that means that the lenders are going to want a higher return. And sometimes the coupon rate is called the coupon interest rate, or just simply the rate on a bond. This is all the same thing. It's just the ratio of the coupon payment to the par value. And importantly, this never changes. So only the yield to maturity changes. Once you buy a bond, that coupon rate is set. But the yield to maturity can change because, of course, as a buyer of those bonds, you can make money in two ways, which is through the coupon payments, and also if you sell it before the maturity. So when the bond matures, you get the last coupon payment as well as that par value back. But of course, market prices can change before the maturity because rates can change. So if I bought a bond, say 5 years ago, that has a 10-year maturity, I still have 5 years left on it. But in that time, say that rates went down. That means that other investors can't buy a bond at as high as rate as what I have. So that makes my bond more attractive, so the price would go up. So you could sell it, and that's how the yield to maturity changes over time, but the coupon rate never actually does. And obviously look at the slides as you always do, and you can look at slides 42 to 44 for bond terminology to make sure you don't get these things confused. And further, there are several types of bonds. So the first one is like a treasury bill, note, or bond. So those are just different phrases for them, but they're all bonds. And that just means that they are issued by the federal government. And the reason they use the different terminology is just the length. So I believe the bill is the shortest, and then the note is like a medium time frame, and then the bond is long term. But again, they're all bonds. And of course, based on the time frame, they carry different rates, or different coupon payments. And then next is municipal. So this is issued by local, county, or state, and these are not taxed. So that's usually not taxed. So that's an advantage of those. And then last, so it's similar to a treasury bill, obviously, except it's by either a state or a city. And of course, there's a higher chance that a city can't make their payments as opposed to the federal government. So there's a little more risk associated with those. And then finally, of course, corporate bonds, and these are issued by private corporations. And recall that these are rated by risk as well. So they're not all created equal. So this goes from AAA to junk bonds. And of course, as you move from treasury to corporate and from AAA all the way to junk, the risk increases, or the default risk increases. So of course, the coupon rate goes up. So again, that's just a quick reminder of, we've covered most of that stuff already. So we can just do a few quick practice problems. So suppose that the interest rate on a taxable corporate bond is 5% and the marginal tax is 28%. Also suppose a municipal bond, which is tax-free, carries a 3.75 coupon rate. Which one would you choose? So of course you want the highest rate. So this is a pretty simple calculation. So the 3.75 is not taxed, so that's what you get. So you're comparing this to the corporate bond, so you get 0.05. However, it's taxed at 28%, so you keep the rest of that. So you keep 1 minus 28%, which equals 72% of 5, essentially, which is 3.6%. So, of course, the question is asking which one would you rather have. You would rather have the municipal bond because that's actually a higher rate after tax at 3.75 compared to 3.6. Next, they talk about the current yield. So this is just an approximation of the yield to maturity on coupon bonds. So like I said, you can obviously sell it at any time. You don't have to hold it all the way to maturity. So the formula for that is pretty simple, where it's here, where the yield equals the coupon payment divided by the price. So another easy example here. What is the current yield for a bond that has a par value of 1,000 and a coupon rate of 10.95%? The current market price for the bond is $921.01. So obviously you just plug and solve this. This is a very easy one. So the answer is 11.89%. So notice that your yield can go up in one of two ways. Obviously, that's if the coupon payment goes up. That's pretty intuitive, obviously. Or if price goes down, which is the current price, which obviously makes sense as well. If you get the par value of 1,000 at the end, you want to pay as little as you can today, knowing that you're still going to get that $1,000 when it matures. So again, current yield, very simple. So this is the timeline of holding a bond. So as I said already, of course, say today you buy a bond, that would be times 0, and you would pay the $1,000 face value. And then however long the maturity is, which is obviously set before you buy the bond, you get that many coupon payments. So in the first period you get one, the second period you get one, the third period you get one, all the way up to the maturity, however long that is, where you get the last coupon payment plus the face value or the par value, same thing, or the $1,000. And the pricing of the bond is based on the market rate. That's what they call it in the book. This is also sometimes referred to as the discount rate. I tend to like the terminology of discount rate better, but obviously if you see market rates, the same thing. So you can think of this as like, what could you have earned over that time? So obviously finance, basic finance, time value of money, you'd rather have money today as opposed to money a couple of years from now because you can invest it and earn money from that. So if you're discounting something that's going to happen in the future, and what is it worth today, it's based on that market rate or discount rate. That's why it's in the denominator here. So over time, like I said, you get these coupon payments, and then at the end, you get the coupon payment plus the face value. So this is just pricing a bond. And of course, like I said, you have to discount it in each time period, where you can see there's actually should be a 1 exponent here. And then second one, you discount it, you square it, etc., all the way up to t, and that is where t is the years to maturity. In a more general form, so they talk about, so this would be one that's annual, where you get 1 coupon payment a year. Most of them, I believe, are semi-annual, but they can even be every quarter, that would be 4 times a year, every month, 12 times a year, etc. So the general formula for pricing this bond is here. So PN, where N would be the number of coupon payments per year, or what they call compounding periods. So again, if they say semi-annual, that means you get it twice a year, so that means N would equal 2. So this is the same exact formula here. It's just a generalized version of it, depending on N, or those compounding periods. But again, as you can see, it's the same thing. So obviously, if it's semi-annual, you get 2, so this is the first 6 months, but the coupon is always stated in yearly. So if you say that the coupon rate is 10% on a $1,000 bond, that's $100, but that's $100 per year, but it's paid semi-annually. So you would get that divided by 2, $50. So it'd be C equals 100 divided by 2 per year, 50, and then you get another 50. Obviously, it never changes all the way until maturity. And of course, because of that, you have to divide the interest rate that you discount it by 2 as well, because that's always also stated in yearly, but the compounding is what makes the difference there. It compounds every 6 months or every quarter or every month, etc. And this would be up to NT periods, where T is still the years to maturity. But again, so say that there's semi-annual over 5 years to maturity, there's 10 total payments, total coupon payments, or 2 times 5. So again, that's just a generalized version. If a question asks, if it's not compounded yearly or just 1 coupon payment a year, it's the same formula, just a little different because of N. So again, we can do a quick example here. So suppose a $1,000 face value bond that has a 10% coupon rate and matures in 2 years. Assume semi-annual compounding. What is the current price if the market interest rate, that should say rate, not date. Or the discount rate is 12%. So you just plug it right into this formula above. And of course, it's asking for the current price, where it could give you the price and ask for something else. But in this case, they're asking for the price, so it's pretty simple. So the price equals, so 10%, so it would be $100 is your coupon payment, divided by 2 because it's semi-annual, so there's twice a year. And the discount rate is 12%, or 0.12 divided by 2. And again, since it matures in 2 years, but N equals 2, automatically you should know, with this NT here, you should know that there's 5 total payments. And the book actually separates out this part here into 2, but the denominator is the exact same. So I think it's easier just to keep it in 1, because then you know if you're solving the problem, if you figure out NT, or the time of periods, you know how many of these you should have, how many times you have to discount the coupon payment. So of course, like I said, the coupon rate never changes. So of course we know that's 50, so I'll just write it that way. We know that this is 6%. And then finally you get the 50 plus the face value. There. And that turns out to be $965.35. So obviously you can do this by hand with a calculator. It would be easier to just plug it into Excel. Like if, for the exam or something, you could already have typed in, this is the face value, this is the par value, or I'm sorry, this is the face value, this is the coupon rate, etc. And you can just plug them into the cells. Or, of course, you can use a financial calculator or the financial calculator in Excel, where there's you just simply plug in the number of periods, the face value, etc. So again, we've covered some of this stuff already in earlier chapters. There are still obviously some key terms that you should learn, and those are in the slides. But this chapter is a bit of overlap. So just obviously be prepared for some of these questions, these quantitative questions. So now I will move on to, and if anybody wants practice questions for the exam, I can give you a few. So just let me know on that. Again, the only difference would be is if the question asks for something different than the price, but it's all the same formula here. So moving on to chapter 13, stock market. So again, I will go over just generally what the stock market is. I know we've talked about it already, but just like the bond market, I'll just review. So of course, the stock market, this is another way for corporations to raise funds. So obviously governments don't do this, and now this is only corporations. So that's their two main ways of raising funds, through issuing stock or selling bonds. However, stocks, this is not technically borrowing, where bonds is borrowing from the perspective of the firm, because this is essentially selling ownership. So when a corporation issues stock, where they can do that in IPO or SEO, where IPO is initial public offering, so that's when a private company goes public, or an SEO, which is a seasoned equity offering, which is essentially just like an IPO. It's just after they're already public, they're just issuing more shares. So by doing this, they're effectively selling a portion of the firm, or equity, stock, equity, same thing. So that's why they call it, it's public now. Now the stock owners literally own the firm. So what you see in the news and everything like that when you track the stock market, like the New York Stock Exchange and NASDAQ, and there's more, those are just the big ones. These are actually what they call over-the-counter markets, or like secondary markets. So this is when people or institutions can buy and sell stocks from each other. So if you go on Robinhood or something like that and buy Apple stock, you're not actually buying it directly from Apple, you're buying it from somebody else who already owns it. So stock or equity is riskier than bonds, for the same firm, obviously. So you could probably find a junk bond that is riskier than a really big company's stock like Apple. But for the same firm, stock is always riskier than bonds, because in the event that a firm goes bankrupt, the bondholders get paid first. So the only way that somebody who owns equity gets paid in that case is after all of the bondholders are already paid. So if there's no funds left, they're out of luck. Or even if there is a little bit, maybe they only get partially paid back. So due to the hierarchy there, essentially stock is always riskier than bonds. So because of that, of course, investors would require, I put demand here, a higher return. And I put that in quotes because it's not a certain thing, of course. So it's what they would call like an expected return. If I invest in stock, I expect to earn a higher return than what I would buying a bond. But of course, they're not guaranteed, as coupon payments are guaranteed. Of course, in the stock market, you can lose money. So in any given day, obviously, the company stock can go down. Of course, you don't actually lose the money unless you sell it. But historically speaking, the market return is about 8 or 9%, which is greater than bonds. So in the aggregate, on average, the fact that stock is riskier bears out in the data that on average they do earn higher returns compared to bonds, which makes sense. So that follows the theory that stocks are riskier, so there's a higher return on them. Then there's something called the bid-ask spread. So this is the difference between what the seller of a stock wants to get paid for it, and that would be the ask, and then the bid, of course, would be the person who wants to buy it, how much they want to bid. So obviously the bid is always a little bit less than the ask, because obviously if you're buying it, you want to get the lowest price. If you're selling it, you want to get the highest price. So there's always a little bit of spread there, and this is highly influenced by the demand and supply. So if there's a bunch of shares that somebody wants to sell and not very many people who want to buy them, or on the flip side, if there's a ton of people who want to buy them but just not enough people who want to sell them, that's going to influence the price. That's what moves prices in the short term. So of course, if there's a huge demand and very small supply, the price will go up, and the opposite is true as well. If there's a huge supply but barely any demand, prices will go down. And we think of this as like affected by the fundamentals, where if you recall the efficient market hypothesis that the current price should reflect all publicly available information. So of course, if news comes out that a certain like Kroger they missed earnings, then of course we're going to expect the price to go down. But like the mechanism that drives that is like the supply and demand, or the bid-ask spread. And the bid-ask spread is, of course, influenced by that supply and demand. And again, this isn't like specifically stuff that I will test you on. It's just going over the basics of the stock market. So investors can earn capital gains. So again, unlike bonds, investors are not actually lending money as you buying stock. You are literally buying part of the company. You are part owner of the firm as a stock owner. So that's how they're a little different than bonds. So an investor, somebody who buys stock, you can earn what they call capital gains or dividend payments. So that's the two ways you can make money, where capital gains is just simply the stock going up or going down. So if you buy stock for $100 and then in a year it's at 110, you sell it, that $10, that's your capital gain. And then the dividend, of course, is similar to a coupon payment. So this is just a portion of the stock price that companies pay out every quarter. And of course, they say the percentage. And a pretty high percent would be like 6, 7, 8%. But that's pretty rare. And generally speaking, what they call value stocks tend to pay higher dividends than growth stocks. And a lot of growth stocks don't even pay any dividends at all. So a lot of firms don't pay dividends at all. And that is because investors would be expecting a much higher upside. Like if you think of Tesla a couple of years ago, they didn't pay any dividends, but investors are expecting a lot of capital gains in the future. Where value stocks tend to pay a higher dividend because they're companies that have been around for a long time, and their price is very stable. So the chance at capital gains is smaller. So to compensate investors, they pay higher dividends. And this is just generally speaking. This is not a hard rule. But the important part is that these dividend payments, although they look a lot like coupon payments and like calculating the current price, they are much different because they're not guaranteed. So when you buy a bond, those coupon payments are guaranteed, unless, of course, the firm goes bankrupt. That's the only way that you would not get paid those coupon payments. But the dividend payments, the firm can change at any time that they want. Like recently during COVID, I owned some Ford stock, and they declared they used to pay like 6% dividends, something like that. And they just said, hey, obviously we're not doing very well. We're not going to pay dividends anymore going forward. So they're not at all guaranteed in the same way that coupon payments are. Now on to some of the quantitative stuff. So there's a one-period valuation model. So again, this looks very similar to bonds that I just went over with their coupon payments. So this looks a lot like the last period of a bond. So you get the dividend with D or D1, you get the price of the stock, and then you divide it by, they're just using this KE, but you can think of it as the same thing. So they call this the required return. And again, you can think of that as, it's similar to the discount rate. You can think of that as what you could have done with your money. So that's why you have to, again, time value of money, you have to discount it, the future, into today. So they use KE instead of R, but you can think of the same thing. It's the same sort of idea. So now moving on to the generalized dividend valuation model. Again, this looks very, very similar to the bonds coupons, but again, it's actually essentially the same. Again, the only difference is those dividends are not guaranteed. But if you look at this formula here, it's basically the same exact thing. As you move on to each period, the difference is this exponent all the way up to n, where n is the number of years. I know last time I used t, the book kind of switches back and forth sometimes, which I think is confusing. But again, that's just that's the number of periods. Where if it's yearly, if it's annual, that's the same exact thing as t, but the only difference being is if it's compounded more than once a year, then you just have to take that into account. So a generalized form of this is obviously the infinite sum, and this is in the book too, so you'll probably see this. So this symbol here just means to infinity. So from t equals 1 to infinity, all of these discounted dividends. Where obviously with this exponent, the further into the future it gets, the less it is worth today. And again, where t, I don't know why they switch back and forth between n and t, but it's the same thing here. So, I'm not going to do an example of that because, like I said, it's exactly like the bond formula. So now on to the Gordon growth model. And this simplifies this valuation to infinity. So of course, if you really needed to calculate something all the way to infinity, you couldn't calculate an infinite amount of these separate things. So to simplify that is something called the Gordon growth model. So anybody who's interested in this won't be tested, but this is just it's an infinite geometric sum. So again, this right here, these two things are the same exact thing. It's just the sigma is the summation symbol. But those two are the same exact thing. See where it goes all the way to infinity. T goes to infinity. So of course you can't realistically do that. And again, it's just completely different, a different way of writing it here. Same exact thing though. So what you can do is, and this part here won't be tested. Again, I'm just going to go over it in case people are confused, like how did we arrive on this formula from here? So suppose that this P0, the price today, is this. Let me use a different color here. So this would be the same exact thing as this, where you let xt equal 1 plus g over 1 plus k, or the required rate of return. So just this equals the same thing all the way out into infinity. So then if you multiply that by x, it is x squared, this goes to x3, this goes to x4, etc. So you're just multiplying it by 1x. So of course then you can subtract the p times x from p, and that's here. So then the reason you would do that is because all of these terms cancel out all the way to infinity. So the only thing you're left with is this first one. And then of course you finally arrive on this. So you got rid of all of these other exponential terms other than just x to the first, which of course is just x. And you rearrange this equation where p1 over x, you just divide 1 over x over. So then you're left with this. And then since, like I said, x equals this, you just sub 1 plus g over 1 plus k back in to this formula here. And it's just that then you get this, and then it's just a little bit of algebra where you divide that over, and then finally you are left with this. So this is what's in the book. So again, you don't need to know that whole process. just people that are interested. It's just a little bit of algebra. It's not any magic going on. But of course, the reason that people use the Goran growth model is because this is way easier than doing an infinite sum. That looks like this. But again, this right here is the same as this right here, which is the same as this right here. And recall that D1, or the next period's dividend, is today's dividend, or the last one paid, times 1 plus the growth rate. So some of the questions that are asked, that is the thing that I think can be tricky. So that's why I wrote it here again, and I'll show you that in these next two examples. So find the current market price of Coca-Cola stock, assuming dividends grow at a constant rate of 10.95%, and the last dividend paid was $1, and the required rate of return is 13. So the reason I think this can be tricky is you might be tempted to do this. Right? But remember this formula, it's D1. So next period's dividend, where the question says the last dividend paid was $1. So you have to calculate D1, which is in this equation here, or in this formula here. So obviously all you have to do is, the calculation isn't hard, it's just remembering to do it. And actually this is KE minus G, so it's the required rate of return minus that growth rate. And this turns out to be, so that 1.1095, that is D1, that's next period's dividend. Which turns out to be $54.12. So again, I mean, obviously it's an easy formula, it's an easy calculation, but just depending on the wording, you have to remember to calculate what period dividend are you looking for. And just recall again that this is the formula, D1, not D0. I'll just do another one. So same sort of idea, and you should expect little twists, obviously, on the exam. I can't give you the same exact questions, but so this one is just asking for you to calculate something different using the same formula. So they're telling you firm XYZ is selling at 22 a share, so they're giving you P0.